Today's conversation is about fiscal risk, deficits, and macroeconomic impact. And I know that it's going to be a very hot debate in Kerala. The budget, it's like a prelude conversation we are having here. So in this budget, what we are going to face is a kind of fiscal crisis is there in the state or not. So in order to analytically examine those questions when the budget is presented, this lecture will be very helpful. So what I'm going to do is I will take you through the analytical framework and the theoretical debates behind the financing pattern of deficits and the threshold levels of deficit, but not exactly getting into the numbers. But to set the context, I can tell you that what are the parameters you have to look opening the budget document to understand whether the state is in fiscal crisis or not. So we know that the white paper is an anvil. I think before the budget, the white paper on state finances may be published. So the three basic questions for that white paper, as I understand from the media, one is whether there is a fiscal crisis in state, how can you substantiate? Second, what are the reasons for that fiscal crisis? And third, what are the ways in which you can come out of that crisis? So these are the three basic questions the white paper will be looking into. And I think they are preparing it, and at any time it can be up. So how do you measure fiscal risk? There are different parameters to it. One is you look into the numbers of public debt to GDP ratio. And in Kerala, if it is approaching 40%, should I be bothering about that? Or can we substantiate that 40% of GDP by use of public debt in our state? Why we are using it? Can we grow out of that debt if this debt is used for economic growth purpose? This is question number one. The other parameters in addition to public debt to GDP ratio is your fiscal deficit to GDP ratio. So we know that there is a threshold norm, even in Maastricht Treaty, in the European Union context, that we know that it is going to be 3% of GDP or deficit. But in the post-pandemic fiscal strategy, if you look into, we know that it is not 3% in any states of India, it's little above. So an articulation is there in our country for this FRBM, we will do an amendment. And right now, the FRBM states that fiscal deficit to GDP has to be maintained at 3% of GDP. Then there is also a golden rule. Golden rule in the sense, in the budget, as you know, there are two components. One is your revenue budget, the other is your capital budget. So in the revenue budget, if the revenue receipts is able to tackle the revenue expenditure, that means the revenue receipt and revenue expenditure, if you look into the gap, it should be zero. That means the state is completely financing the revenue spending, the recurring expenditure from the revenue receipts we receive from the tax and non-tax, then we are fine. Then whatever we borrow, that will entirely go for financing the capital spending. So that's a golden rule. So we have to look into the numbers of revenue deficit to GDP. So I mentioned about public debt GDP ratio. I mentioned about fiscal deficit GDP ratio and the revenue, the golden principle that the revenue deficit has to be zero. So these are the broad ways in which we can analytically examine if a state is in fiscal crisis or not. And the fourth important parameter to look into when we talk about the fiscal risk is look into the interest payments to revenue receipts ratio. Like we are receiving revenue receipts from the tax and non-tax sources, but how much of that revenue receipt is going to finance the interest payments? And if it is above 15% and not, then that is non-productive. So we need to look into this ratio. Then another important component is how much is the revenue deficit as a part of fiscal deficit in our state. If the revenue deficit as a part of fiscal deficit is huge, then there is an alert. So these are the ways in which we can broadly, as students, you can look into whether the state is in fiscal crisis or not. Now, look into the reasons for that. Take the revenue budget first. Look into the revenue spending. So if the revenue spending on pensions, or for the organs of state, the establishment expenses, that is little fiscally profligate, So we need to look into that, how much the state is spending on this fiscally profligate establishment expenditure, how much the state is spending on health and education, how much the state is, financing that debt servicing, interest payments. So these are the major components we need to analyze. And structured analysis of the RBI state finances, if you look into the data, you can see three functional categories of spending. The first is like economic services, second is your social services, and third is general services. Economic services, of course, for the infrastructure, irrigation, adaptation, climate, a lot of components are there in the economic services. Social is completely related to the Kerala model of development, in which the education, health, these are the important components. Then general services, that is a recurrent kind of spending, like you can look into the interest payment, you can look into pensions, salaries, and see the ratios of these three categories in total expenditure. If the social services to the total spending is higher, then we know that the state is supporting the Kerala model of development, that we are spending on health and education. But, we saw the data, it's not economic services which is the predominant component of the revenue expenditure in the state of Kerala. And over the years, the general service is on the rise. In the sense, the money we are spending on the organs of state, the money we are spending for the interest payments, pensions, these components are on the rise. So we need to see how we can, streamline the spending, and are we focusing much on capital spending or not? So then comes the debate, including the KIB model, that if you don't focus on the capital spending, and if you're worried only about the fiscal consolidation, what exactly is fiscal consolidation? We maintain our fiscal deficit to GDP ratio at 3%. But the target is important, but path to that 3% is equally important. If the path to that 3%, if it is not through the tax buoyancy, but through the expenditure compression, then it can adversely affect the growth process in future. You can understand, right? Because, we can consolidate, we can do the fiscal consolidation through tax buoyancy. When the taxes are not buoyant, when the revenues are uncertain, then to reach that fiscal consolidation, if you are prone to do expenditure compression, that's going to affect the growth recovery process. So the stand which Kerala government always took is disappearing deficits have macroeconomic consequences. It's very peculiar argument, and the way we support deficit is good by arguing disappearing deficit also have macroeconomic consequences. It's not only that you have huge deficit, the deficit has macroeconomic consequences, so we have to curtail the deficit, but at the same time, beware, disappearing deficit has got equally important macroeconomic consequences if you're following the path of expenditure compression. So that's the punchline which Kerala government put forward. Now, look into the capital spending. We have a KIB model here. KIB model in the sense, there are different concepts of deficit. I have written a book, as Professor Shija, Shija ma'am has rightly pointed out, my second book was on the fiscal deficits and macroeconomic impact. And in that book, in the second chapter, I wrote about the different concepts of deficit. So there, the correct assessment of a deficit in a country is PSBR. PSBR is public sector borrowing requirement, but public sector borrowing requirement data is not ready because we don't have data of intra-sector public sector transactions, and this public sector borrowing requirement has to be covering the 3 tiers of government, the general government kind of deficit, but we don't have the data related to the 3rd tier. So these are the constraints in which PSBR could not be constructed, the time series data could not be constructed. Had PSBR on board, we could have captured the borrowing that's happening through the outside the purview of fiscal deficit through the public sector entities or the kind of corporate bodies. You know, by definition, fiscal deficit is a net borrowing requirement of a government which doesn't include what we do through the kind of corporate bodies and public sector entities. So central government also followed this model. They kept the fiscal deficit cleverly around 3%, but the OBB, the off-budget borrowing, was so high and they kept it as an annexure. So that fiscal transparency is what is a political economic question in the context of Kerala. Because when the budget comes, we ask the question, why this deficit is not reflecting the entire borrowing of this state? And what Finance Minister argued was also correct. In the fiscal deficit, that's not the part, this OBB. But PSBR, that construct can capture what's happening through the KIB and the off-budget borrowings. Now, KIB model is important or not, the question that is again has a political economic question. One is, of course, it's not only Kerala, which engages in the OBB, all the states engages in OBB, and even the central government. And second question is, do we need to do external financing? Because we have gone to the London market and the interest rates were higher. So that was another debate. Then it's argued that there are two kinds of bonds over here. One is the rupee denominated bond, which is masala bond, just like you can have the parallel in China, which is a dim sum bonds, and we have dollar denominated bonds. And what we have engaged in is a rupee denominated bonds, not the dollar denominated. So the exchange rate fluctuation, many things we preempted, but we focused on the rupee denominated masala bonds. But the interest rate was higher. Then the question is, can we mobilize funds internally at a better rate of interest? So these were the questions asked. So if you ask me the relevance of KIB, of course, I am for the capital infrastructure financing models, but do we need to London market or not is a question which can be raised. So we need to be dispassionate about this analysis and about the estimates. Now, in order to analyze all these things, this is I'm setting the context of what's happening around in Kerala. In order to analyze this, first you need to know the different concepts of deficit. Second, you need to know that it's not only the levels of deficit that matter, but how you finance your deficit. That is also an equally matter of concern. Then you can unpack whether the persistent deficit crowd out the private corporate sector investment. So that's a biggest fear. If you have persistent deficits, that's going to crowd out the private corporate investment, because in the loanable funds market, things are limited. So if you're preempting the loanable funds to finance your deficit, what is available for the private corporate sector may be limited and it can increase the interest rate. So these are the theoretical arguments and we need to dispassionately analyze this empirically. So first, look into the analytical framework. Second, take it ahead to the data, look at the numbers. Then using a fantastic model, stylized facts we call, then get into the econometric estimation, get the inferences, provide the evidence to the policymakers. So that's the way this journey has to happen, from the theory to the data, to the inferences and the policy making. Otherwise, opinion, it will be just an opinion if you don't go through this process of looking into the empirical evidences. Okay, now a little bit of work I can do. Let me start with the intertemporal budget constraint. So I mentioned about the deficit, and you know that it's a deficit is the difference between the debt past and the present. So that delta D. And this is nothing but IG I mentioned here as investment related spending. So this is basically our capital budget. Now CG is nothing but consumption expenditure. It is, you can call it as a revenue expenditure. So from the expenditure, I am deducting the non-debt creating revenue receipts. So that's represented, and it's a kind of a primary part of this. So intertemporal budget constraint has one more part, that is a past, interest payments. It's nothing but the rate of interest and your past debt, okay? So I put it as T-1. So this is your primary balance of the primary surplus of primary deficit part. and this is past. And there was an important debate happened in India when this FRBM committee was constituted, whether we need to focus on the fiscal deficit, which is, including the primary and the past debt, or whether we should be focusing only on the primary part, because this R is exogenous, interest payments is exogenous, and this is the past liability of the previous governments. So we need to focus on the current fiscal policy stance. Then we need to look into only this part. We forget about the past liabilities. So that's the way it is argued, whether it is fiscal deficit we need to capture or the primary deficit. And former Chief Economic Advisor Arvind Subramaniam was very vocal about focusing on the primary deficit, because we need to focus on the current fiscal policy stance, not on the entire, including the past liabilities. Now, I mentioned that the threshold levels of the deficit, that is 3%. Then we have the golden rule. Golden rule, I mentioned that the RD has to be 0. So, in addition to focusing on the levels of the deficit, we need to look into how we are going to finance the fiscal deficit. So, for instance, let's begin with financing through a traditional manner, to seigniorage. Seigniorage is nothing but how much is the high-powered money in the economy to GDP. That is the seigniorage. So this is technically the definition for the seigniorage. So let's begin with the seigniorage financing. There are different ways in which we can finance a deficit, but let's begin with that. It immediately have the effect on the monetary base in your reserve. And I don't know whether you have taken a look into the RBI handbook of Indian economy. There, you get a table on the reserve money. So I focus on two important components of HPM. It's a high-powered money or the reserve money. The two important components are, one is the debt with the central bank. Central bank means, we can finance a deficit through that net RBI credit to the government. Of course, over the years, we reduced this component, but the central bank financing the deficit, that's one way of doing it. Then another important component of the reserve money is your forex. And there was a major institutional reform in our country that happened to reduce this monetization of deficit in order to control, this overall HPM. High-powered money was going up, reserve money was going up, it was inflationary, so we needed to control that. So we focused on the net RBI credit to the government, or the, this is the central bank dealing with the deficit. But we could not control. It was mounting because that time the forex was booming. But had it been the case that this and this were equally accelerating, then the case would have been different, that this would have gone up like anything. So we could control this over the years. Then you can ask me the question that what's the way in which we took a shift from the monetization of deficit to bond financing. So this total debt financing, it has got two important components. One is you can do through the central bank. The other is you can do through the bond financing or the financing with the public. So this is what is predominantly happening in India. Now we are doing the bond financing of deficit, and over the years we controlled the debt with the central bank or the net RBI credit or the monetized deficit, and we moved towards DB. Now instead of this debt with the central bank, I can write that the total debt minus DB, right? Forget about the details. I just wanted to do a kind of financing pattern of deficits by taking this variable on the other side, and you have the seigniorage financing, then you have the debt with the public, then you have to run down your forex. Okay, so these three components. Now this fiscal deficit can be financed through seigniorage, can be financed through the bond financing and external financing. Now you can ask me the question, this transition from the seigniorage to the bond financing, the purpose was to control inflationary pressures. Could we control that? And now it's more than 70% we are here. There is a concept called unpleasant monetary arithmetic. Unpleasant monetary arithmetic is The only flexibility you have is inflation today or inflation tomorrow, whatever way in which you finance your deficit. In the sense, you transit from seigniorage financing to the bond financing to control the inflationary pressures, but inflation will be a reality after a certain point of time, even if you go for the BF, bond financing. In the sense, two important variables now happening, the debate is happening in Kerala as well, R and G. The rate of interest, the real rate of interest and the real growth of economy. So the argument by the Kerala government, I mentioned that the punchline our state is giving is disappearing deficit has got macroeconomic consequence. So don't bother about the threshold, ratios like 3% fiscal rules. There should be a little discretion about that, but check your R and G. R is the real rate of interest, that's a cost of credit, and G is the rate of growth of economy. So if you can grow out of your debt, then you can substantiate the purpose of debt. So that's the way it is argued. But the moment the rate of interest is going beyond the growth of economy, then your debt is unsustainable. So when you do the bond financing, check R and G, and if R is greater than G, then you have to eventually monetize your deficit. So that is why I mentioned that arithmetic is going to be unpleasant. So this is a kind of a tug of war between the monetary policy and the fiscal policy. And in the unpleasant and arithmetic, that kind of a theoretical framework, the first mover advantage is given to the fiscal policy makers and the monetary policy follows. Now you can ask me a question, what could be an alternative for this advantage of the fiscal policy makers will take the first mover advantage. Had it been the monetary policy makers, then they finance the deficit, whenever there is a crisis. And we have done that in India till 80s. Like we had only one concept of deficit, that was, monetized deficit. It's kind of a deficit financing. You have, the treasury bills. Using the ad hoc treasury bills, you kind of finance your deficit. And that's the way we have done the monetization of deficit earlier. Now, other concepts of deficit. First, I mentioned about the fiscal deficit. Then I mentioned about the monetized deficit, which is a net RBI credit to the government. Then I mentioned, primary deficit, which is a current fiscal stance. That is total fiscal deficit minus the interest payments. Then you also can take a look into the cyclically neutral fiscal deficit. But there is a huge, debate regarding the cyclically neutral fiscal deficit, because in order to construct the cyclically neutral fiscal deficit, you need to assume that the business cycles exist in an economy. But there are evidence in which, in the context of emerging economies, we know that this business cycle doesn't exist just like that. Like you cannot date the ups and downs in the economy. So when the business cycles are not predominant, then you need to follow the hysteresis model of economic development. That also has implications on the cyclically neutral fiscal deficit you're going to calculate. So Finance Commission, many organizations have not looked into the cyclically neutral fiscal deficit because the concept of that output gap was not convenient for the context of emerging markets. In the sense, output gap is a difference between your potential GDP and the actual GDP. And actual GDP, you know that it is the gross, value added plus FISC. FISC is, I mentioned in the last class also, indirect taxes minus subsidies. So that's the way National Statistical Office gives us the GDP data. So you look into the sectors for the GVA and you look into the FISC. Now, come to the potential. How do you calculate the potential growth of an economy? What is your potential? So that's an unobserved variable. So the way we do that is through the econometric models, through the filters. We have a lot of filters, Kalman, HP filter. What exactly is happening is that in a series, there are two components. One is a kind of a trend component. Even a human being's behavior, you can see that there's a trend and there's cyclicality. So if the trend is okay, you don't bother about the cyclicality. So that's a basic philosophy. So what they do is they take out the cyclicality component and look at the trend and call that as potential. Now comes the question that can it be called potential? Because potential is a kind of an envelope that you reach to the next level. But there are limitations in which this potential output is calculated. So we call that trend as potential by taking out the cyclicality using or filtering out the cyclicality using the HP filter, Kalman filter, whatever it is. So that's a limitation. So there is a theoretical limitation. There is a kind of a methodological limitation in coming up to that output gap. But RBI, different ministries of finance around the world, they all use this output gap as a concept to look into the macroeconomic policy outcomes. Now, that's not quite helpful, so that we need to acknowledge that there are limitations in the concept of output gap. So, what about unpleasant fiscal arithmetic, which is an alternative of unpleasant monetary arithmetic? I mentioned that in the unpleasant monetary arithmetic, the first mover advantage is given to the fiscal authorities and the monetary policy follows. But in the unpleasant fiscal arithmetic, you are giving a central bank independence. The first mover advantage is given to the monetary policy makers. Then the fiscal policy follows. So should we be following that model in our country? So if you ask me whether there is a central bank independence, CBI, we know that the independence we seek is in terms of operational independence. Now we know that the institutional reforms happen in our country. We have a new monetary policy framework, and as per the new monetary policy framework, instead of RBI governor announcing the thing, we have the voting, we have the MPC, the Monetary Policy Committee. So they deliberate and they announce the rates, the policy rates. So that's the independence we seek, not the goal independence. Goal independence in the sense, the primary purpose of a central bank is price stability. And that articulation came through this new monetary policy framework, that everything else, it's not in the purview of RBI. RBI needs to look into only the price stability. So are they doing a good job? Like price stability means inflation containment. And the contemporary macroeconomics, that narrates that we are not doing a great job. If you look into the consecutive quarters, the inflation is beyond the comfort zone. A comfort zone in the sense, how do you articulate that? Every country, interprets what is the official inflation that's allowed in a country. That's a nominal anchor. In US, they call it as 2%, but in India, we mentioned that it is 4%, but strict 4% is quite tough. So we kept a band of +2. So up to 6%, if it is CPI, then we are in comfort. Beyond 6%, then we are uncomfortable. And, if it is beyond 6%, we have to articulate the reasons for that by looking into those numbers, and RBI governor is answerable. And there is a confidential report right now, just submitted by the RBI governor, articulating that why we are unable to do the price stability. And one of the prime reasons of that report is it's mainly because of the global economic headwinds, and because of the geopolitical uncertainties, because of energy price volatility. So once that exogenous factors are controlled, then we will be into the safest zone. So it's mostly interpreted as the global inflation. And now how we are responding to that, we are increasing the interest rates. So why we are doing the interest rate defense? Interest rate defense always affect the growth recovery process. In the sense, we need to keep the interest rate lower for better investment purposes and the growth recovery. So when we are doing an interest rate defense, we need to articulate that it is required for the inflation containment, which is the prime purpose of the central bank. So the growth versus inflation, if you have to look into, RBI governor always will give that sequence of priority to the inflation containment first prior to the growth recovery. Now, in this first mover advantage, what fiscal policy has to do is it has to remain accommodative, because monetary policy is completely focusing on inflation containment. And fiscal policy needs to be accommodative. And how do you interpret it has to be accommodative? Accommodative in the sense, high fiscal deficit, high debt. We are going to articulate that these are all used for financing the capital infrastructure. The capital infrastructure is going to crowd in private corporate investment. So we can substantiate, and we also use it for reducing the output gaps. So are you comfortable with this argument that we have a high debt which is mounting up to 40% of GDP? Then, if you substantiate that through the use of deficit, that we are using it for capital infrastructure investment and to reduce the output gaps, are you comfortable in having this high fiscal deficit and high debt? This is a question we need to ask. And then there won't be any fiscal crisis because we will be able to grow out of the debt if you're using the debt correctly. And why the debt is considered as a villain? Because as I mentioned, if it is monetized, then you have inflationary pressures. If it is through the bond financing, then the pressure will be on the interest rate and it will crowd out private investment. And if it through the third way of financing the deficit through the external financing, then you will have a lot of issues related to the balance of payment, what has happened in Sri Lanka. But we don't have to fear that, because if you look into these three components, unlike Sri Lanka, what we're doing is internal financing of deficit. So that Sri Lanka situation may not occur in the context of our country, because we are not externally financing deficit significantly. Now, had it been the external financing of deficit, we need to look into the capital flows. And capital flight, as I mentioned, we have to look into the open economy macro models. And Geeta Gopinath, she made a smart statement that the existing macroeconomics textbooks needs to be revised considerably. And she highlighted that the Krugman, so she tweeted with the textbook cow pages that these are the textbooks, including Krugman's book. Because the international finance, the capital flow, so there are a lot of debates happening and changes happening in the open economy macroeconomic models. So the textbooks need to be revised from that perspective. So we can expect a new edition of these books, because she's very serious about the revisions of the macroeconomic textbook which is given to the students. Now, look into the open economy macro models. I mentioned about the capital flight. Predominantly this capital flight now occurring because of one central bank's decision, that is the US Fed Reserve's decision to go hawkish. And they are increasing the interest rate. Of course, that is important for them because they need to reduce their balance sheet. And they have given that statement in the Jackson Hole meetings recently. Now, what is its impact on the emerging countries, including India? Unless we do an interest rate defense, the capital is going to be flighty, because the component of the foreign exchange in India, it's hot. So hot money, that responds to interest rate differentials, and where they find attractive interest rates, the money will flow to that. And we have seen the instability. We have seen the FPI outflows. The foreign portfolio investors are moving out. FDI is relatively stable, but FPI, that's moving out. So interest rate differential is crucial. The next question is, RBI governor is very bothered about the negative rates of interest in India. Negative rate of interest in the sense, inflation is mounting and your nominal rate is now kept around 5% and the inflation is mounting above 6%. So the nominal rate of interest minus inflation, that real rates of interest is negative. If the real rate of interest is negative, then we need to worry about the financialization of savings, because we are not getting even what we have deposited in the banks. So if the financialization of savings is coming down, be bothered that interest rates needs to be made attractive, otherwise we have to control the inflation. Then comes the question, what about the fiscal deficit? And we asked the North Bloc and the center, the state governments, Department of Finance to be accommodative. Then the predominant narrative is, if the interest rate is shooting up, then the cost of borrowing of a government is going up. So you can feel a conflict of interest over there. On one hand, interest rate, that inflation targeting you need to maintain. Inflation targeting is nothing but your nominal anchor of inflation. It's deviation from the inflationary expectations, which is an unobserved variable, and you float surveys to do that. Then your output gap. So in this process, output gap, I again mentioned that your potential is unobserved. So these unobserved variables you tackled, and you come up with a rules-based monetary macro in our country. But the question here is, what about the cost of borrowings of the government if you raise the interest rate? Because public debt management is also a cup of tea of the central bank. So in this conflicting priorities of the public debt management versus inflation targeting, now the central bank is giving importance to the inflation targeting or price stability more than the public debt management. So the argument is that there should be an institutional reform in our country to keep this public debt management separate from the purview of the central bank. So these are the recent debates which is happening, and maybe I'll stop here. Look forward to your questions, and that's it. Thank you so much. Over to you for questions.
Ma'am, ഒരു ക്ലാരിഫിക്കേഷൻ വേണ്ടി ചോദിക്കുകയാണ്. എന്ന് വെച്ച് കഴിഞ്ഞാൽ ഇപ്പോൾ ഓൾറെഡി 40% നമ്മൾ GDP-യുടെ ഡെറ്റ് ടച്ച് ചെയ്യുവാണ്. അപ്പോൾ ഈവൻ ദോ നമ്മളത് ക്യാപിറ്റൽ എക്സ്പെൻഡിച്ചറിനെ ഫിനാൻസ് ചെയ്യാൻ വേണ്ടിയിട്ട് കൂടുതൽ ഡെറ്റ് ഇൻകർ ചെയ്യുന്നതുകൊണ്ട് ഡെറ്റ് ഈസ് സസ്റ്റൈനബിൾ എന്നുള്ളതാണോ മാമിൻ്റെ ഒരു ടേക്ക് അതിനകത്ത്? പിന്നെ അതേപോലെ തന്നെ നമ്മൾ ഈ ഓഫ് ബഡ്ജറ്റ് ബോറോയിങ്സിനെ ഇതിനകത്ത് ഈ ഫിഗേഴ്സിനകത്ത് ഇൻക്ലൂഡ് ചെയ്യുന്നില്ലല്ലോ. സോ ഓഫ് ബഡ്ജറ്റ് ബോറോയിങ്സിനെ ഇൻക്ലൂഡ് ചെയ്താലും അത് പ്രൊഡക്റ്റീവ് ഡെറ്റ് ആണ്. ക്യാപിറ്റൽ എക്സ്പെൻഡിച്ചർ മീൻസ് ക്യാപിറ്റൽ അസറ്റ്സ് ക്രിയേറ്റ് ചെയ്യാനുള്ള ഡെറ്റ് ആയതുകൊണ്ട് ഡെറ്റ് ഈസ് സസ്റ്റൈനബിൾ എന്നുള്ളതാണോ? മാമിന്റെ ഒരു ആർഗ്യുമെന്റ് എന്താണെന്ന് അറിഞ്ഞാൽ കൊള്ളാമെന്നുണ്ട്. എനിക്ക് അറിഞ്ഞുകൂടാ അതിനെപ്പറ്റി കൃത്യമായിട്ട്. ആക്ച്വലി നമ്മൾ കുറച്ച് ലോജിക്കലായിട്ട് ചിന്തിക്കുന്ന സമയത്ത് നമ്മൾ എവിടുന്ന് റവന്യൂ റേസ് ചെയ്യും എന്നുള്ള ഒരു ക്വസ്റ്റ്യൻ ഇല്ലേ? ആക്ച്വലി നമ്മൾ കുറെ വർഷമായി ഡെപ്റ്റ് കൂടുകയാണ്. നമ്മൾ അതിനനുസരിച്ച് കുറെ മോഡൽസ് പ്രപ്പോസ് ചെയ്യുന്നു. അതിനൊരു സൊല്യൂഷൻ ആയിട്ടാണ് നമ്മൾ കിഫ്ബി കൊണ്ടുവരുന്നത്. അതിനുശേഷമാണ് RBIയുടെ ലെറ്റർ വരുന്നത്, യുവർ ഡെറ്റ്സ് ആർ ഇൻക്രീസിംഗ് ഈവൻ ദോ ഇറ്റ്സ് ഓൺ ബഡ്ജറ്റ് ഓർ ഓഫ് ബഡ്ജറ്റ്. സോ അതൊരു സ്റ്റാറ്റിസ്റ്റിക്കൽ മാനിപ്പുലേഷൻ ആണ് എന്നുള്ള രീതിയിലുള്ള കുറെ കോൺട്രവേഴ്സീസ് ഉണ്ടാവുന്നു. അതിനുശേഷമാണെങ്കിൽ പോലും നമ്മൾ എങ്ങനെ റവന്യൂ കണ്ടെത്തും എന്നുള്ള ഒരു ക്വസ്റ്റ്യൻ ഉണ്ടല്ലോ. ഇപ്പോൾ ടാക്സ് പോയിന്റ്സ് ഇംപ്രൂവ് ചെയ്യാം, അതല്ലാതെ നമുക്ക് വേറെ ന്യൂ സോഴ്സസ് ഓഫ് ടാക്സസ് കണ്ടുപിടിക്കാൻ പറ്റിയിട്ടില്ല. GST വന്നതോടുകൂടി മറ്റേ ലോക്കൽ സെൽഫ് ഗവൺമെന്റിന്റെ എല്ലാ റവന്യൂ ഷ്രിങ്ക് ചെയ്യാണ് ചെയ്യുന്നത്. അതേ കൂടെ നമ്മുടെ ഇൻഫ്ലേഷൻ വരുന്നതിനനുസരിച്ച് സാലറി കൈക്ക് വരുന്നു, പെൻഷൻസ് ഇൻക്രീസ് ചെയ്യുന്ന വി ഡോണ്ട് ഹാവ് എനി ന്യൂ സോഴ്സസ് ഓഫ് റവന്യൂ നമ്മൾ ഐഡന്റിഫൈ ചെയ്തിട്ടില്ല എന്നാണ്. അപ്പോൾ ഈ ഒരു സിറ്റുവേഷനിൽ എങ്ങനെ നമുക്ക് ഈ ഫ്രഷ് റവന്യൂ ഇൻജെക്ട് ചെയ്യാൻ പറ്റും എന്നുള്ള ഒരു ക്വസ്റ്റ്യൻ ജെന്യുവൻ ആയിട്ടുള്ള ഒരു ക്വസ്റ്റ്യൻ അല്ലേ? താങ്ക് യു.
Ma'am, I have a question related to that. You said that not just how the deficit is financed, the channel through which it is financed is also significant. So, if we finance it through the reduction in the expenditure, then it would have an impact on the economy. That's why now the government is going for capital expenditure enhancement. But my question is, why they are pursuing capital expenditure enhancement to tackle the macroeconomic effects it could have? Are we simultaneously also reducing the public expenditure in the form of pensions or other such expenditure, that revenue expenditures that we are increasing? Is there a simultaneous process going on? Otherwise, or is there revenue generation going on? Otherwise, it would just mean that we are going on increasing capital expenditure. And the thing is that the growth rate must trump over the real interest rate for the debt to be sustainable. So that would mean that the state must go at the rate more than 7% or 9% state growth should be there. Are we achieving that? Is it possible? And I've read that if the ratio of debt to state GDP exceeds 60%, then it's an irrevocable point. Then it's a dead man's score. You cannot come back. So you have stated that the state is already at 40% point. So what does that mean? For how long can we keep on borrowing?
Good morning, ma'am. My question was that you just proposed that the way forward should be tax buoyancy over expenditure compression. But again, both of them are fiscal policies. So do they encroach upon the credibility of the central government? Now, I'll just elaborate two incidents. So in Europe right now, that's like reading up like the effects of the Ukraine war. One thing that the central bank is being forced to do is to raise the interest rate. So that is raising the consumers' mortgage payments, and that may lead to a tanking of the housing sector. Then there was a incident about about how the central government, central bank, is putting forward measures to persuade the workers to not demand higher wages. But then it actually spectacularly backfired because there were public workers' strikes that have not abated, and it continues unabated. So do you think that fiscal policies are leading to an arm twisting of the central bank?
Good question. Your name?
Diya, ma'am.
Priya.
Diya.
Diya. Okay. Diya, Akhil, and Arun. Yes, Arun. Yes. Yes.
Can the private sector investment, corporate investment, can they take over the economy and lead it to an economic growth? Is there any negative implication for this private? Is there any negative implication for this private corporate investments that?
I'm Shafiq Rahimi, one of the research scholars here. Actually, all the governments provide facilities for the people. They are working really forcefully. Might be close. Yes, okay. My sound is loud.
You're recording it, right?
Oh, right. So, basically, the government, due to to stop this deficit, two ways there: to reduce the government expenditures or to increase the tax. Both sides will impose the problems for the people. So what might be the specific way or solving way to fix these challenges? Yes, that's my question. Thank you.
Okay. Thank you so much for the 6 questions you have asked. Okay. Now, let me begin with the private corporate investment and then, connect it to the other questions. You are concerned about the debt sustainability. So let me begin with Sneha's question, and then I can connect it to all other concerns, including the European Union context you cited, Diya. Okay, let me tell you that we are economists. So we need to put forward the proposition based on empirical evidence. So now the question raised by Sneha is what determines private corporate investment, or how the private corporate investment can be made attractive so that can sustain the growth process. And there are a lot of models which look into this public investment and private investment. And basically, these models are, dollar to dollar displacement, the direct crowding out literature. The second is financial crowding out. If you're increasing, the preemption of resources in the economy to finance the deficit, that is leading to crowding out of private corporate investment. So these are the ways in which economists look into the question related to what determines private corporate investment. It's not an easy analysis at all. For instance, if you take into the models of the direct crowding out, the dollar to dollar displacement, then you have to ask a question: $1 increase in the public investment leading to the displacement of $1 in the private corporate investment, or is it crowding in? So that's a question, and it cannot be a bivariate model. You need to control for many other variables, so that you need to know this relationship. And in the econometric models, we know that we cannot just run the regression because there are endogeneity issues, simultaneity, so many econometric issues we need to tackle, and there should be without an endogenous and exogenous division of variables, you need to tackle it in a symmetric or asymmetric vector autoregressive models. So these are the ways in which you solve the methodological issues. Now comes to the financial crowding out question. So there, this direct crowding out will not give you the answer. And this, you can start reading from the blind and so that does fiscal policy matter. There's a beautiful paper. So you can start from there. Then you can also look into the budget deficit symposium by Janet Yellen, who is now the Treasury Secretary. That paper is in Journal of Economic Perspectives in 1986. So these are the starting point of you look into this empirical question. And if you can come out with a result that persistent deficits or deficit does not crowd out private corporate investment, then that can be a wonderful proof to substantiate that persistent deficits are okay. So that's a way you can argue. So that question starting point is good. So before getting into the financial crowding out part that's coming through the interest rate mechanisms, I can also mention that the direct crowding literature, if you look into high frequency data, or you have to look into the over the years, a deep time series data. So there are questions. And to look into this public-private investment, we don't have high frequency data. So if you're providing the model, it will be a hysteresis, like a historical perspective you have to look into, because the frequency of data is going to be annual. You don't have less than annual data for this private and public corporate investment. Now, how do you get into the high frequency data models and provide the government what's happening right now? So that's another question. So if you have to look into that, the contemporary relationship, you have to get into the financial crowding out. There we get the high frequency data, that there are many variables, rate of interest, there are many variables, deficit, money supply, external debt variables, everything you get for the less than monthly frequency data. So get into the high frequency data models, look into the question of financial crowding out. So prima facie, the argument is that deficit is a villain which crowds out private corporate investment. Deficit is a villain that shoots up your interest rate. So the argument is that if the deficit does not have predominant macroeconomic consequences in the country, why do you fear deficit? So this is a way you can argue. As economists, you need to give the evidence. So interest rate determination you need to look into. Interest rate determination model is nothing but what I explained as financial crowding out. So interest rate, again, it's not easy. The structure of interest rate variables, if you look into, to provide the empirical evidence, there are many interest rates. So which is this particular interest rate you have to take to analyze this relationship of deficit and interest rates? That's an important question. So you have policy rates, which is repo rate. Then you have term structure of interest rates. Term structure is nothing but the short and long that is related. Short-term interest rates are treasury bills, call money markets, but these are highly volatile. You need to select an interest rate from the data set which is less volatile and less, stable. It should not be like a stable rate. Like if you look into the bank rates, if you look into the prime lending rates, you can see a stickiness. So which could be that interest rate which is non-sticky, non-volatile, what could be that reference rate of interest. So that's the way you collect your interest rate. And I have seen many studies which looked into the 91-day treasury bills as one of the variable, or they get into this bond financing like government securities, which is about 10 years, the long term. So these are the interest rate variables you can look into. Otherwise, you can take a laudable funds market model in which you look into the term structure of interest rate and also put the deficit variable. Term structure of interest rate in the sense, the shorts and longs are also related. So you're keeping both the interest rates into that model. Then you look into the money supply. Of course, the money supply and interest rate, that relationship is little unsettled. If you look into the stylized facts, it can be positively related or negatively related. But the stylized facts of other variables are okay. Deficit and interest rate, prima facie, we are thinking that it's negatively related. Higher the deficit, the interest rate will shoot up, positively related. Then your interest rate will also, if the deficit goes up, interest rate will also goes up. So external variables you can look into, the rear, near, capital flows, all these variables. So these are the ways in which you build up your model. Decide on your right econometric model. As I mentioned earlier, you have to deal with the frequency of variables, high frequency data or the annual data. If you are taking into the annual data models, then you have to deal the question of the short time series. Econometric models, you know that if you have short time series, then you cannot provide a very good inference based on the short time series. What exactly you're trying to say if the observations are limited? Then, econometricians have sorted out these issues by looking into what are the ways in which we can deal with short time series data. Short time series data, there are two predominant ways. One is in econometric, there was a model. It's comparatively easy, which, when we do one-to-one conversation later in which you can do the models, then, you came to a conclusion that Todo and Emamoto, that work in econometrica, that provides a solution for the short time series data. Otherwise, another important methodology which you can try is maximum entropy ensembles methodology. Maximum entropy ensembles in the sense, your time series may be limited to less than 40, but they create ensembles. It's like a reincarnation. You create ensembles up to 999 observations, and then that beta, the coefficient you check may not be of 40 but of the new data set of that ensembles, and you check it is that beta is within your confidence interval. So these are the ways in which you tackle the short time series. Now, after doing all these things, you have to give the inference to the government that I am getting a relationship that deficit does not matter for shooting up with the interest rate, or I'm getting a relationship that deficit matter, and we need to be curtailing the deficit because it's affecting the interest rates. So these are the ways. It's very complicated, very deep, very extensive, elaborative models, but I can give you the overall generalization of what's coming up. It's not an inconclusive study. In the context of India, if you look into the RBI works and all, you can see that the interest rate determination may be basically from the inflationary expectations but not coming from the deficit. So these are the ways in which the models give you the inferences. And looking into the corporate investment models, it's not the interest rate. Interest rate may be important, lowering the interest rate, but predominantly it is the public investment, especially public infrastructure investment that crowds in private corporate investment. So these are the ways in which you can take a look into the handbook of econometrics. There's a study by that famous econometrician Rishikesh Vinod of Fordham University, New York, and Honeykaran in IMF. I'm also called of that paper. So we have done extensively this maximum entropy ensembles model and came to a conclusion that the predominant variable that's important for the private corporate investment is public investment. So that's exactly what is trying in the context of India. Of course, you can argue me back that it is going to be having a lagged effect in the economy. It's not instantaneous. So it's going to be a lagged effect, but more than the monetary policy variables, it is the fiscal, in the sense you may have high fiscal deficit, but it is going for financing the private, the infrastructure investment. Go for it. Now, let me take the girls' question first. Okay, Dia's question. Dia's question. I love that articulation of the European Union. You rightly mentioned that in the context of European Union, of course, they came together based on an economic integration. This monetary policy, as you mentioned, is exogenous. They have that fiscal policy flexibility in which they can operate the economy. Monetary policy is exogenous in the sense the central bank is outside. That ECB is outside. The Christine Lagarde is leading that. Now, if you are going towards that Maastricht Treaty of maintaining the deficit at 3%, what is the flexibility or what are the adjustments you need to make in the economy so that you maintain this Maastricht Treaty 3% of deficit? And that you mentioned that what are the ways in which you do that, including rationalization of the wages. So that can affect, this question is very relevant. So in that case, structural policy reforms were given importance because the understanding was that a growth process happens due to the cyclical factors and the structural factors. If you're focusing just on the cyclical factors, as I mentioned earlier in my lecture also, if you are doing that output gap estimation, you think that you correct the cyclicality and you get the growth back to the prior recession or prior pandemic levels. In the sense, I mentioned the dip in the growth, if it is happening through a permanent scar, then unless you work with a structural policy, if you're looking only into the cyclicality, then you cannot get that upturn, V-shape or U-shape, whatever you talk about. So structural reforms are very crucial to get into that. And another major debate is, what exactly is the outcome variable here? Is it growth or is it a climate resilient growth? So this is another important debate in the context of European Union. Now, in the ECB, the Christine Lagarde, she asked a question whether this monetary policy has got a commitment more than price stability towards the green economy. And her articulation wasn't positive. Like, she mentioned that even monetary policy has got an important function for greening the economy or for the climate resilient or climate change commitments. Then, on the other hand, Rekha Rajan, many macroeconomists who are doing the monetary policies, they are against monetary policy getting into the climate commitments. In the sense, their argument is that the toolkits available for the ECB or any other central bank is to look into the price stability. If you don't have enough toolkits, that can lead to reputation risk, so don't get into that. Then, Bank of England, they got into this debate by going for a stress test. It's kind of a green stress test. And RBI is also comparatively open for greening the monetary policy. It's a kind of, we may think that there is no connect between climate change and what RBI is doing. But there are different chapters in the recent RBI publications which mentions greening of monetary policy, which is very important. So when we talk about the outcome, what exactly we are looking forward, it's not just GDP growth, but it has to be a climate resilient growth in the economy, and climate change commitments need to be looked into. On the fiscal policy side, we ask the fiscal policy makers to remain accommodative. Then their purpose is just GDP, or what does it mean? That's a question Akhil also asked, whether we should be just focusing on the capital infrastructure investment, or whether should be looking into the humanitarian crisis, whether we should be under the impression that the revenue spending is all bad. We need to focus just on the capital, because that's a kind of a predominant narrative now happening. Like, you just focus on the capital and you get your growth path all right. Then if there is a trade-off between the revenue spending related to the human development, then there could be an adverse macroeconomic consequence. So it has to be resilient. So I take the point by Akhil that it need not be like strictly focusing on the capital infrastructure, but you also need to maintain the assumption that revenue expenditure is not that bad. Curtailing revenue expenditure also have macroeconomic consequences. Now coming to the question of Akhil, everything is fine, capital compression is bad, but where do you get a revenue from? If I don't have revenues, then should I be declaring a fiscal austerity? This is what exactly has happened in European Union. They had this Maastricht Treaty of 3% fiscal deficit norm. Their revenues were not buoyant, so they went into the fiscal austerity mode. So just imagine what will happen in Kerala if you get into the fiscal austerity mode. The first, it will affect the salaries, pensions, freeze. We don't have money. Where is the money? That is fiscal austerity. Or revenues are not buoyant. We are unable to find the tax buoyancy because it's a recession. So this gap needs to be filled through responsible borrowing. So these are the alternatives, two paths in front of you. One is, of course, you are shouting at me that I am irresponsible finance minister. My debt is mounting above 40%. I'm not raising my taxes because I don't have enough sources in my country, in my state. So I'm going for exploring or innovating my debt models, and you're not allowing me to do that because your argument basically is it creates intergenerational inequity. What is intergenerational inequity? You're putting the future generation into debt. You know that there are three schools of thought regarding deficits. One is the neoclassical argument, which I mentioned to Sneha, that a persistent deficit crowds out private corporate investment. And this is the predominant macroeconomic narrative across countries, including the World Bank and IMF, that states that neoclassical models, which deficit is bad. Now coming to the question of Keynesians, they say a timely fiscal deficit is good. In the sense, if you pitch your deficit at the right time, if it's leading to the growth recovery process, go for the deficit. That's going to, help your economic growth recovery and human capital formation. So deficit is good. You own that narrative for a time being because it will help you. But of course, I'm not talking about the fiscal profligacy, because we have debt mounting and we do, we buy cars for our secretaries, which is more than crore or something like that. No, not the fiscal profligacy I'm talking about, but a responsible debt management in the state. Otherwise, you're getting into fiscal austerity mode. And that is going to affect the economy in a manner in which that leads to humanitarian crisis. It will affect the growth process, but you are fiscally disciplined. You don't have any deficit beyond 3%. Your public debt is controlled, so everything is fine. And also, Akhil asked me, where to? Now it's mounting to 40. After some time, it will become 60. Where to? The public debt to GDP. And up to what point I can go ahead? And I can tell you that there are many countries in which the debt to GDP ratio is above 100%. But those countries are growing. So if you look into the debt GDP ratio, whether that's a helpful narrative, or you need to look into the indicators related to the fiscal risk other than debt to GDP ratio is a question. That, many examples are there that they live with more than 100% debt, but the country is growing. So how do you use the deficit is very important. Now comes the question of Arun asking me, what are the ways in which we can raise the revenues? And he rightly articulated that a state government is facing macroeconomic uncertainties. And if you look into the Musgravian function in the class 1, in the public economics class, we learned that macroeconomic stabilization is a function of center government. Now the state are facing the macroeconomic uncertainties. So what are the ways in which you can support the state, or whether the states are able to increase their debt? What are the other sources of revenue? First, let me check the revenue sources. One is on tax, the tax revenue and non-tax. Within the tax, GST, as he mentioned, it's not within the purview of the state governments after the revolution. And non-tax revenues, of course, I'm not talking about the insignificant sources like lotteries. And Kerala is a government, or we people don't believe in user charges. Education, health, we don't want to charge, user charges or user fees are very low in our country, in our state. So we don't have major sources of revenue. Of course, we need to see the tax handles at the local level. That is very important. So this on one side. Second, a predominant source is the intergovernmental fiscal transfers. What is happening over there? Intergovernmental fiscal transfer, of course, it is conditional and unconditional. Unconditional intergovernmental fiscal transfer happens through Finance Commission. It is based on a formula-linked, transfer based on population, area, climate change, tax effort. There are many variables which decides how much a state is going to get. And in that narrative, Kerala lost out in the sense our per capita income is growing. So over the years, we cannot argue that the devolution is getting less and less, because we need to understand that per capita is a predominant variable over there. And if the per capita is growing, then that's going to be inversely related. Another important factor is population. Finance commissions decided that they will use the recent population. So our state control the population. So what's the logic that if the population is going to be the predominant narrative, then the states which control population may lose out. So there are different ways in which this intergovernmental fiscal transfer is argued, but the good news is that the revenue deficit grants Kerala got was very good, but it's going to get, it's over already. So we don't have much, revenues or the sources of money that's coming from the intergovernmental fiscal transfer. So the finance minister needs to articulate that based on that, bargaining power with the center that's going to happen. The next finance commission is going to be constituted very soon. So we need to see the articulation of states, how much money we can get from the center. So these are the revenue uncertainties. And, there are models in public choice literature. You call it as flypaper. Money sticks where it hits, right? So a local politician, he always or she always look into the sources of funds that's coming from above. Because we citizens have a money illusion or a fiscal illusion, because we don't know the source of funds. So if the bureaucrat or the politician can get more money from the intergovernmental fiscal transfers, he need not get into the tax effort, or he need not, make the citizens vulnerable or dislike him by asking for more taxes. So as we citizens, we don't know the source of funds. So the relationship, if you look into the econometric models, the local level spending and the coefficients, if you look into the intergovernmental fiscal transfers and the owned revenue, the intergovernmental fiscal transfers and the local spending, that coefficient is greater than owned revenue. Then you can tell that the flypaper effect is working and the money sticks where it hits. So these are the political economy model. Now my last point is related to the public choice literature and these voting models. And we know that Anthony Dons, William Lekha, they come up with the voting models, that why do people vote? So in retrospect, people vote the government, based on their public finance decisions. What are the important public finance decisions they have taken? That last mile connectivity, everything work when they vote back the government to the power. So the public expenditure decisions are also, that democracy determines public expenditure, or democracy also determines the way you finance your deficits. So broadly, these are the different ways in which you can look into. My final point to Arun is India, tax evasion and the kind of literature related to, the moving towards tax havens, evading taxes, this is very high. So people are unwilling to pay taxes. So they don't reveal their preferences sincerely. They reveal their preferences strategically related to the public goods. So there is a problem over there. When compared to the Scandinavian countries, there you can see that the tax rate may be 40, 50, and they willingly pay taxes because there is a Vixelian link. Vixelian link in the sense how much you pay and what is a utility you gain from that, it's there. The role of state is visible. So here we have a rich vocabulary of tax evasion, and there are reasons for that because this Vixelian link breaks every time. So there are issues in which we can raise taxes, but as many tax economists pointed out, in the context of state like Kerala or in emerging economies, tax administration is tax policy. So when you get into the tax administration, including even the digital infrastructure, that can improve little bit of your revenue, not by raising rates. If you raise rates beyond a point, Lekha curve operates. Lekha curve, you know that it will come down beyond a point, you will not augment your revenues if you raise the rates. So these are the concerns related to the tax literature. So that's why this deficit narrative is quite strong right now, and these are the moments in which we have to own the narrative that fiscal policy needs to be accommodative. That's it.